My name is Barry Weinstein, and I was a foreign exchange trader for one of the largest banks in Switzerland, as well as for one of the largest hedge funds in Europe. In this video, I'll be discussing the top 5 mistakes that new traders make and how you can avoid making them. Mistake number 1 that new traders make is going against the trend. When markets are increasing and accelerating, it's generally not a good idea to short sell. When markets are decreasing and accelerating, it's generally not a good idea to buy. But when markets are decreasing and decelerating, meaning going like this, there might be an opportunity for a reversal, and if markets are increasing and decelerating, that's the same thing. According to 3 economists at Yale University, sponsored with a paper sponsored by AQR, the quantitative hedge fund, over the past 100 years, there is evidence of trends, which is successive up movements and successive down movements that occur more than what would be expected mathematically from random price flutters. And volatility FX market speedometer allows you to identify trends as well as identify accelerations and decelerations so that you can make sure that you're not going against the trend and that you're only picking reversals in times where the market is not bulldozing through levels. So let's just go to Kiwi. So I'll click in the currency pair, I'll click NZD/USD. And what we'll see, we can have our price on the top left. We can see that generally the price has been going lower over the past, let's say 21 days. And we have this last sharp movement lower here, which is from 68.55 to 67.76. That's over the previous day. We can see the change, that's the day over day increase or decrease. And we see this very, very large spike to the downside over the past trading session. We can also see the price's acceleration over time. So, and we can finally see the summary that Kiwi has been pummeling lower and the price has been accelerating lower. So if you believe that trends are having an effect here, or if you want to follow a trend following strategy, then you would want to sell and you wouldn't want to buy. Mistake number 2. And that's putting your take profit too close so that you're not capitalizing on your trade, or too far away so that you never capitalize on your trade, or putting your stop loss too close so that the trade is confirmed dead before you can even have a chance to have it play out, or putting your stop loss too far away and not managing your risk and not having an appropriate place to declare the idea wrong. With volatility FX, we'll go to the structure trade idea function, and I'm going to find appropriate take profit and stop loss levels in order to express my Kiwi position that we determined in part 1. So here I'll click find appropriate take profit and stop loss levels, and then it says select your trade's direction. Let's go short because the Kiwi price is going down and decelerating. Then it says to select my risk tolerance. Do I want to have a risk averse trade? So here's a risk averse profile which it'll create. If I'm super confident about the idea, I'll click a risk loving trade. I think with a Kiwi downside trade where Kiwi will oftentimes dump, I'm going to click this one. Or you could click a risk neutral trade. And these will find different probabilities profiles for each one of these trades, and all you have to do is select one of these 3 preset risk tolerances. So here it says select a preset risk tolerance for your trade. I'm going to select a risk loving trade because I really want to capitalize on that Kiwi downside. Let's select next. Select my time horizon. I'm going to be trading this on a daily basis, so I'll click 1D for 1 day, but that goes from 15 minutes to 1 hour all the way up to 1 year, but my time horizon is going to be 1 day. And then finally, how much would I like to risk if I stop out in this trade? Let's say my budget, I have $150 if I'm a retail trader. So I'll type in 150. And then volatility effects will find me appropriate take profit levels, appropriate stop loss levels, as well as an appropriate trade size. So here, with New Zealand dollar spot reference of 67.86, there's a 25% chance that the take profit level of 67.47, that's where I'll put the take profit level, will touch once during the 1 day time frame. If this level touches, your portfolio will gain around $250. Very nice. There's a 50% chance that the stop loss level of 68.09 will touch once during the 1 day time frame. If this level touches, your portfolio will lose $150. Very nice. 44,000 Kiwi or 0.44 standard lots is an appropriate position size if you want to lose less than $150 upon stopping out. And then here we have our time series chart, which shows this previous spike here, and then it shows where it suggests to put our take profit level. We're going short, so it's here at 67.47. Where do we put our stop loss level? 68.09. And if we don't have any sort of risk management, what's our best and worst case scenario? So overnight, we're 95% certain that the price won't go to 68.54 and it won't go to 67.19. So if we do nothing, that's the best and worst case scenario. We can also look at the trade idea metrics, which will show us our trade size, stop loss level, take profit level, as well as various probabilities of different things occurring. Here we have our probability of strategy success. So that's the probability that our take profit touches and our stop loss does not touch. And then we can also see where our target levels are compared to the best and worst case scenario and where we expect spot to land. Finally, we can look at our probability versus payout chart just to show where our take profit and stop loss level is relative to different probabilities and different outcomes, as well as how much we're going to make or lose on the trade in blue. So mistake number 2 is putting your take profit and stop loss levels in places that are inappropriate, and volatility effects will structure those trade ideas for you. Mistake number 3 is simply risking too much. According to the trading platform eToro, 85% of new traders lose money in their first year of business, with a median loss being 33%. Now, while this sounds daunting, if you're smart about it, you can actually make these probabilities move a little bit more in your favor. And in reality, if you are smart about your trade sizing, the odds shouldn't be that much worse compared to relative industries like opening a restaurant, which has an extremely high rate of failure. But volatility effects will make sure that you don't risk more than your budget can allocate by telling you how large your trade should be. So in Part 2, we were discussing the appropriate take profit and stop loss levels, but also volatility effects will suggest an appropriate trade size. In this case, it was 44,000 Kiwi overnight, where we're 95% certain that you will lose less than your inputted budget. So you will have control over how much you make or lose. Finally, mistake number 5 is not knowing your worst case scenario. Twice in your trading life, there could be events that occur with less than 1% certainty, which could drive you into a point where you lose a substantial amount of money. Of course, if you pick these correctly, then you could be on the receiving end of it, but that doesn't excuse the ignorance of the worst case scenario over time. So with Volatility FX, we provide value at risk measurements which show you your worst case scenario, assuming that markets behave as they have been. In this case, we're 95% certain that within the next 21 days, Kiwi does not trade below 64.77. Within the next 5 days, if you're making a trade for the next 5 days, you need to be able to survive a move to 66.37. Of course, we can select forecast value at risk, and this is going to show us how much of our portfolio is going to be risked with different movements. And we can see that we're 95% certain in Kiwi that we lose less than 4.6% for every New Zealand dollar invested over the next 21 days. So there it is. 5 easy mistakes that new traders make and how to avoid them. New traders don't follow the trend. New traders put their take profit and stop loss levels in inappropriate places. New traders will risk too much on their relative to their portfolio's allowance, and traders will not know their new worst case scenario and will put an inappropriate trade size. Thank you so much for taking the time, and we'll discuss more next time on the top 5 ways that traders can improve their trading outcomes.